Hello and welcome to Portfolio Matters. In today's podcast, we will be reviewing the top 10 most popular share talks and doing an update on the companies we covered. This will be part one of a series of podcasts in which we go through updating on the companies we've covered in all the share talk videos. And frankly, during lockdown, we covered a lot of companies. There are about 45 of them. So we have a few companies to get through. But anyway, today we're going to get through the top 10. But before we do it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So Keith, which is our first update?
Okay, so we are going to go through the companies in descending order by the number of views they have had. And number one, by quite a margin, is Portfolio Matters problem child, Rambler Metals and Mining. So we did our podcast on the 3rd of March and we've had almost 3,500 views. And I've taken all the data as of the 30th December. And at that point, it was up 21.2%. But in the last couple of days, we've had yet more bad news, which we will go through. And then we were strongly positive. Okay, so this is the share price, and it had a really poor middle section of the year when essentially there were big question marks over the financing of the mine. The development of the mine seemed to be taking much longer than expected, and was the company going to run out of money and have to issue loads of diluting shares? But thankfully, we finally managed to secure the funding for the Ming mine. And since then, the shares have performed very well up until a couple of days ago when we had an RNS from the company reporting yet more problems. We'll go into that. Okay, so this is the operational update as of the 4th, and essentially they've got some external contractors to work on the mine, and those contractors got ill. They're now isolating with COVID for 14 days, during which obviously they can't work, and that's going to impact the development plan and push back the date at which they're aiming to meet their 1,350 tons per day production target further into the quarter. But it's this last sentence that has worried the market. The company is looking at arrangements to mitigate the financial impacts and report to the market in due course. So will that mean more share issues or failure to provide the metal for the hedge? Bear in mind, they had previously sold forward a load of metal, copper, which they were due to clear in Q1. And we don't know the financial implications, but there's uncertainty, which is always bad for the share price. So in summary, where we are now is that Rambler have had a very difficult and volatile 2021, which has been a trial for a lot of our viewers and for myself, as I have quite a large position in Rambler. But the basics that we covered in the share talk remain true. The new management are getting a grip on the mine and have a completely revised mining plan. So we will go from having just one stope to 6 stopes, which will give them much greater flexibility. And going forward, if Rambler can fulfill its potential, then this should be valued at multiples of where it is now if everything goes to plan. Now, one thing they've done is they've done quite a lot of exploratory drilling over the past year, and the most recent update increased the reserves to 23.7 million tons of ore at 1.8% copper, and that contains 430,000 tons of copper. So this is a big resource and at high grades. The only question really is if they can mine it successfully and profitably. Now, one of the big bull arguments for Rambler was the ore sorter. Remember that about 30% of the ore they process is actually just rock. And if they can kick that out and just process ore, you get an immediate 30% uplift in the mining grade, which would be great for profitability. And the ore sorter is meant to be commissioned this year. So that's upside. So now the financing is complete. Hopefully, we have seen all the shareholder dilution from new share sales, although this week's RNS raises some uncertainty, but that is a temporary problem. And when those contractors come through COVID, you'd hope we get back to normal.
So I was going to say, you wouldn't think that people being off for 2 weeks should, also should have that big an impact on their cash flow, and therefore you would hope they wouldn't need to do fundraising for that reason, because it would suggest that they were incredibly close to the wire if they had to.
Well, that is the point, Richard. The fact they've had to put out this RNS and say at the end they're taking steps to mitigate the financial impact suggests they're sailing very close to the wire despite all the fundraisings. Now, the copper price remains at a very good level, much higher than the models, the long-term assumptions that Rambler have made in their financial forecasts. So as long as that continues, Rambler looks like a very good investment. And this year, hopefully we can put 2021 behind us and Rambler can start fulfilling its potential. Okay, so in summary, when we did our share talk all those months ago, and before, frankly, a lot of share price volatility, we were strongly positive. And after all that, and despite the recent RNSs, which have a reminder, delayed production due to the need to build access to the lower footfall regions, and also because of COVID, that's this week, I remain very positive, and I think that at some stage, Rambler's fortune should turn around. It should begin fulfilling its potential, and there is a lot to look forward to. Richard, your thoughts?
I'm positive for the same reasons that you are, Keith, and I think the copper price has quite a long way to run over the next few years. Rambler will be ramping it up its production into that elevating copper price, in my view. I think for people who are a little bit nervous of entering the position with Rambler, it is currently trading in a range, and I think when it gets up above about 42, it breaks out of that range, and that may be the point at which to buy some if you're so inclined.
Okay, and on to our second most popular podcast, which was on Bushveld Minerals. Now, Richard and I have, frankly, bad memories of this. This whole experience of covering Bushveld taught us a lot, and actually quite a lot of good came out of it in the end. But at the time, it was a very bad experience in that we did a podcast on a company that I was vaguely aware of had a big following on the bulletin boards. And if you haven't watched the podcast, we were mildly positive with caveats. And the big caveats were that the bull case for Bushveld was based on the vanadium price rising strongly on the back of demand from vanadium redox flow batteries. Now, we did quite a lot of work on vanadium redox flow batteries, and the bottom line is that they are being undercut in price terms by lithium-ion batteries. And so we failed to see how you could have a bull run in vanadium when vanadium redox flow batteries are already more than twice the price of lithium batteries, because that would make them even less price competitive. And so we didn't think there was any case for a bull run in vanadium. That got us an enormous load of abuse. And I'm quickly skipping forward to that. And that taught me a lot. I mean, in general, I think one of the big challenges as an investor is remaining open-minded about all your shares and not getting wedded to a position, and listening in particular to dissenting voices and deciding whether they're right and then selling them. So what we got in instead was loads of abuse, calling us shorters, stupid and ignorant, etc., etc., which was actually very unpleasant at the time. But very good things came out of this, actually, because we then decided that we needed a space where private investors could actually, who wanted to swap information, could do so in a pleasant and supportive environment. And we set up our own Discord channel, and that has been a great success. So it also taught me actually that we should be wary of covering companies which have a big following on the chat rooms, because those are not the sort of investors we necessarily want to interact with. But a reminder, this is the share price, and frankly, we were absolutely right. Since when we covered it, it was at 18.35p. It is now, well, it's fallen back down since December. It's now at 9.2, so it's more than halved. And actually, thank you to all the people who sent me a load of abuse, because I decided I didn't want to be a member of the club of Bushveld Minerals shareholders, and I sold it up here, saving me quite a lot of money. So thank you. And one thing that I had known of, but not properly understood, was that companies that have a very strong following on the message boards tend to underperform the market. And there have been various academic papers on this, and now I know why. Essentially, it's a filtering mechanism where people only want to hear good news, and they systematically bid the stock up. And there are people on there who had enormous positions in Bushveld Minerals and hence only wanted to hear good news. So, Richard.
Just out of curiosity, how does that explain the poor performance? Because you would have thought, prima facie, that if it had some enthusiastic investors who would hold on despite poor news, that would be supportive of the price.
Well, they bid it up far higher than it should be, is the bottom line. And then it's kind of slowly drifts off. And also, I believe that there's a selection bias. They tend to go for very high risk, small, speculative companies. And so actually the vast majority of those tend to fail medium term. So they don't cover, they're not going to be buying National Grid. They're going to be buying a small speculative, copper mine or whatever. Actually, rather like the companies we cover.
Yes.
But in summary, we don't cover it anymore. So actually, we're going to skip on. Okay, and on to number 3, Ferro-Alloy Resources, which are developing a big vanadium prospect in Kazakhstan, of which news later, because obviously there's currently unrest in Kazakhstan, which has affected the share price today. But we came across Ferro-Alloy Resources while researching Bushveld, and if Ferro-Alloy Resources can develop their enormous Balasausqandiq black shale deposit using essentially a new technique of essentially putting the ore in a big pressure cooker and extracting the vanadium that way rather than baking it like Bushveld Minerals are doing, then it's much lower cost. If Ferro-Alloy Resources complete all their development plans, they will substantially add to world vanadium supply, which would be very bad for high-cost producers, but very good, potentially very good for Ferro-Alloy Resources. Now, since we started covering it in March last year, the share price has fallen back, but those of you with long memories will remember we started covering it in early March, and in the 2 weeks it took me to complete our presentation, it received funding from Sir Mick Davies and Vision Blue, and the share price absolutely shot through the roof. It has since drifted off, but was picking up in the last few days until literally today, when its share price has fallen heavily on the back of the revolution, the unrest in Kazakhstan. We'll have to see.
They put out this morning. They put out an RNS key saying that their production and their operation was completely unaffected yes. by the disruption.
Yes, no, I saw that, Richard. But the if it gets worse, the fears would be, they could be affected.
So I think Russian paratroops have gone in to sort it all out, haven't they?
Yes, to quell the unrest caused by terrorists. Terrorists being the entire population
who can't afford the fuel.
Yeah. Okay, so where are we? Well, Vision Blue have now invested a total of 10.1 million. They're due to carry out some exploratory work on the first ore body, OB1, to better understand the underground geometry starting in February, so next month. The big news is the bankable feasibility study has been commissioned. And once we have the bankable feasibility study, then that can be used to secure funding, and essentially the mine development starts in earnest from there. And that is expected to be completed in Q4. Now, until that happens, the shares will probably likely drift because there's no catalyst. But eyes on the long-term prize. If this gets developed, this is an enormous project, which is very valuable. So phase 1 would see the process of 1 million tons of ore per annum to produce 5,600 tons of vanadium pentoxide. Phase 4, that would rise to 22,400 tons. And I believe that total world production is currently less than 100,000 tons. So, that is a very substantial new addition to the world market, which would depress prices, but could also have the effect of really revolutionizing vanadium redox flow batteries, whose prices would come down. And the testing of the metallurgical process they are hoping to use is currently ongoing by SGS Canada. The results emulating working conditions are due this quarter. So that would be a small catalyst. Now, This, if you remember, is the mining life cycle chart. And the trouble is, I think far are here. So we've had the discovery and we're now working through the feasibility, trying to get financing, and there's not really much good news while we await financing, then spending money.
I think they're possibly not slightly atypical in the fact that with Sir Mick Davis in place, he's brought a lot of money with him. So I suspect they're a mixture of down the left-hand slope and up the right-hand slope.
Yeah, I hope you're right. So our original review was strongly positive. People who bought in after our podcast will not have had a good experience. And I added to my position after the podcast, and it hasn't been great. But Ferro-Alloy Resources are my choice for the Portfolio Matters Stock Picking Challenge for 2022, because I think if they can get the bankable feasibility study, then the shares could fly. Richard, your thoughts?
Yeah, I agree with you, Keith. So Mick Davis has form in this in terms of developing coal resources for Xstrata very successfully. He's very well connected, knows what he's doing. And I also know that they are actually producing molybdenum as well. And yeah, basically it's a huge discovery that they can produce at far lower price cost than the current world price. So if it goes well, it should go very well.
Using an autoclave, that's the word I was searching for, has the potential to really revolutionize vanadium supply. And they would be the world's lowest cost producer, as far as I'm aware. Okay, on to number 4, Centamin, the big Egyptian gold miner. And this is one of the first podcasts we did. It's had 1,300 views, and I bought it soon after our podcast, and it hasn't been great, down 27%. And we were then mildly positive. And this is the share price, not great. Now, the reason it wasn't great is that, frankly, gold had a very, very disappointing year. We expected the gold price to have a good year on the back of very low interest rates and rising inflation. So real interest rates were very strongly negative. But actually, the gold price fell over the course of the year. And, gold miners are a geared play on the gold price. And so all gold miners, including Centamin, had a poor year. When I was researching this podcast, I had a look at their latest presentation, and I really, really didn't like this chart. So this is a chart showing the change in the all-in sustaining cost over the course of 2021. And there's a big increase in the all-in sustaining cost. So it's gone from $1,125 an ounce, which is already high at the end of 2020, to $1,425 an ounce at the end of 2021. Now, that erodes a very big margin of safety for Centamin, because previously, when the gold price is at $1,800 and you are making $675 an ounce, that is a good margin. Suddenly, your margin's a lot smaller, and volatility in the gold price really then starts to threaten the profitability of the company. So I have sold my shares because my main view about the dangers of the world economy are the dangers of a rising oil price. And all the gold miners essentially use a lot of oil and energy and diesel to move thousands of tons of rock to produce ounces of gold. So they're very energy intensive. And so as the oil price is going to rise, so their margins are going to be squeezed. And after doing this update, I sold my Centamin and I sold all my other gold miners except for Goldplat, which we also covered, which is a gold recovery expert who don't mine their own gold. They recover it from mine tailings, and so they are less energy intensive. So, in summary, I have changed my mind on Centamin and I've sold the shares. I think they're being squeezed by rising energy costs and flat gold prices. However, they've got a decent dividend of 5.3%. They have this year upgraded their resource base by 23% based on exploration drilling, and the life of mine is now back up to 12 years, and their underground resource looks very good. And they have released a pathway to get them back to 500,000 ounces per annum production. And they're due to meet that in 2024, in 2 years' time. They've also advanced some of their exploration assets around the world, in particular the Doropo asset in the Ivory Coast. They're doing a pre-feasibility study this year. But gold price has had a disappointing 2021, and interest rates are rising now. And typically that tends to be bad for the gold price. You'll see that the gold price is down over 1.5% today. But above all, energy costs are going to squeeze the profitability of gold miners, including Centamin. Richard, your thoughts?
I agree with you, Keith. I was never particularly keen on Centamin, actually. I don't think Egypt's a particularly stable environment, and that was one of the key reasons I was never particularly keen on it. The cost, it is a high cost producer, and as you pointed out, effectively, with the increase in costs and the lack of increase in the gold prices, margins have actually dropped in the past year or so. So although I say no view there, that was rather because it's not a company I'm interested in. So I guess maybe we should revise that to negative.
Right. Okay, moving on. Number 5, Harbour Energy, which was newly listed when we covered it back in April, and we've since had 1,100 views, and the performance has been very disappointing, frankly. We were strongly positive at the time, but the oil price has risen strongly since then, and Harbour Energy shares are actually down, which is quite an achievement, given that Harbour also have quite a lot of gas production, and the European gas price has spiked very strongly. So this is the share price of Harbour, and we covered it back in April about here. I bought some about that point, and I am down. The price has picked up recently, but it's had a few disappointments, particularly on the Tolmount field, which is being delayed, and also the size of the Tolmount field has been downgraded. But over that period, we think back in April, the oil price was around $60, $62. It's now $75. And that feeds straight through to the bottom line of Harbour Energy. So I'm slightly at a loss as to how its share price has fallen so much. And I did a back of the envelope calculation based on the guidance Harbour Energy have put out for 2022 and oil at $70 a barrel. And it's going to throw off a lot of free cash flow. I reckon around 1.2 billion. And that's after capex of 1.3 billion and tax of 830 million, giving a free cash flow best part of 30%. So I think there's great value here, basically. Okay, so in summary, it's got quite a lot of debt, which means it's highly geared to rising oil and gas prices in theory, though frankly, not in practice recently. And I am puzzled by its underperformance. It's guiding for between 195 and 210,000 barrels of oil equivalent per day in 2022. That's up 16% on 2021. And Tolmount should come online in Q2, although the reserves of the Tolmount field have been downgraded. And at these oil and gas prices, it is generating very strong cash flows. And it has instigated a dividend policy and will distribute 200 million, which is 16p a share in the coming year, putting it on a dividend yield of about 4.5%. And they have stated that at current oil and gas prices, they could clear their debts of 2.4 to 2.5 billion by 2025. I mean, they're throwing off vast amounts of cash. So I'm puzzled by their underperformance, and I have a decent size holding. And at some stage, I believe the market will start to appreciate. So our original view was positive. Now the oil price has gone up and the gas price has gone up and Harbour Energy shares have gone down. I'm strongly positive.
So I was listening to the Today programme this morning, Keith, in which they interviewed Sir Ed Davey. And I had forgotten this if I ever knew it. He used to be the Energy Secretary in the coalition government. And so he knows a little bit about it. What they were discussing was the adverse impact on many millions of households' finances of the current huge increase in energy prices, and alongside tax increases and a perfect storm of household finances coming under extreme pressure. And he said he didn't think any of the current proposals for alleviating this problem were sensible, but that in his view, the best proposal was a windfall tax on oil companies. Now, that may be one of the reasons, I'm not saying it is, but it may be one of the reasons why people are a bit wary of oil companies, because they are possibly in the sights for windfall taxes and so forth.
Yes, that is possibly true.
So my view is positive for obvious reasons. It is throwing up a lot of cash, but I do think there's a caveat we have to bear in mind. And actually, it's not just oil companies. The resource sector is going to become very profitable over the next few years, I suspect. And it's just so easy for governments to steal that money.
Yeah,
no, that is true. I just think that's a general issue with resource stocks. There's nothing much you can do about it, but I think we need to be aware of it.
Yeah, no, true. Good point. Okay, Phoenix Copper. Well, we covered it in June. It's the podcast have had over 1,000 views, and the share price has had a volatile run. And when I did this on the 30th of September, the shares were up 15%, which was decent enough. But they've had a very bad run in the last few days, and they're down 7.5% today to 47p, which is dangerously close to the point at which we started covering them. And we were then positive. So, yes, if you not so long ago, the shares were approaching 80p, which was a very good return. And since then, there has been no negative news that I can think of, and the shares have come right off. So where are we? Well, we're now the company is moving forward with the development of the Empire mine, and they're now valuing that at current metal prices at about 159 million pre-tax, post-tax 144 million. And the capital expenditure is due to be paid back in less than a year. So just valuing the company on the Empire open pit mine alone, the shares would seem to be quite cheap. But remember that Phoenix own a large area of land, and they're previously estimated that they've so far investigated only around 1% of the minerality on their prospects. And where are they on the mining life cycle map? Well, I think the Empire mine is close to development. They should start construction this year. The other resources they've got are in the discovery and feasibility phase. So we're kind of in the orphan period now, awaiting development of the open pit mine. But reminder that below the Empire open pit mine, there are deep sulfides, and then they're very excited about Navarre Creek, which is a gold prospect, and exploration success there would be positive near-term catalysts. The open pit feasibility study is expected in Q2, but they then need to raise the financing, 52 million, to develop the mine. Now, they are saying that they can do that entirely using debt, and there would not be shareholder dilution from a share placing. But I suspect that is best case scenario. So I remain positive. I mean, the thing is, they're in the wrong stage of the mining life cycle chart. Until we have the feasibility study and the development of the Empire open pit mine, then there aren't that many catalysts unless they have unexpectedly large drilling success. But medium term, I think this remains a good prospect, and I'm sticking with it.
I agree with you, Keith. I think one of the problems with these miners, and the value valley is a really useful graph to understand it, is that when they are heading down to the value valley and at the bottom of it and just lifting off, the price just tends to drift away. So people who are in there for a quick gain become disinterested and move off. Yeah. And it's not really indicative of the prospects of the business. It's more indicative of the impatience of the investors. And I think the key with these is you just have to stick them out. Some of them won't make it. Yeah. And that's the cost of investing in these businesses. The worst thing you can do is try and sort of dot in and out on every little bit of news or every little bit of share price change, because I think that's all. I think you're on a hiding to nothing there. So I agree. This is a buy it, hold it, and wait for a few years.
Okay, Castillo Copper. We put out the podcast in April. It's had just over 1,000 views, and share price has been very disappointing, down 45%. And we then said it was speculative. Now, this is the share price performance, and it hasn't been good. And a reminder for people who haven't seen the podcast, they had reported very good drilling results, but we examined those drilling results and found that they had presented them. I need to be legally careful here, not misleading, but in a way that is potentially misleading. So they had triple counted minerality, the copper grades, in some of those cores. And we broke down the actual copper grades by drill result. They had various drill cores, and we looked at how much copper was actually in those drill cores, and we found the ore body was small and deep. Now, all of their prospects are in the pre-discovery, discovery phase, and many years from production. And essentially, I invested in them, slightly gambling that management would be able to continue spinning any drill results they had in a positive manner, and the bulletin boards would like this, and they would the share price would climb from there. Now, that it was a slightly cynical play which has not worked, essentially. So I have sold my shares. And ultimately, this company remains a collection of small speculative assets. When we covered it last year, they were aiming to be a mid-tier copper producer, was their long-term strategic aim. And then they've gone and bought some lithium assets. And you get the feeling that this company is unfocused. Richard, so my new view is now negative. I've sold it.
Yeah, my view is negative. I never bought it, but I agree with Keith. I think his analysis is spot on.
Okay, finally on to Excelsior Mining, which was one of my a very frustrating investment of mine. So we covered it back in May. Had podcast had 920 views, and since then the share price has fallen by 50%. I was strongly positive, and mea culpa, I got it wrong. This is the share price. Now, you will remember that Excelsior have an in situ copper mine in Arizona where they are having problems. And in the Share Talk video, we went through how they were pumping acid down into the ore body, and the acid was reacting with calcite in the ore body to produce carbon dioxide. The carbon dioxide was building up pressure and then preventing further acid being pumped in. And so then I was confident that the management would find a solution, a technical solution to these problems. And they had thus far surmounted all the difficulties they had encountered. Now, the one thing I missed and turns out to be crucial is that their solution, which was to flush the wells with water to dissolve the carbon dioxide, obviously requires water, and they're in a desert in Arizona. So water is a problem, and there's a limited freshwater supply. So in order to implement their solution to the calcite problem, they're going to have to build a water recycling plant, a deraffination plant, I think it's called. And in order to fund that, they're having to build a separate open pit mine to provide funds, which they can then use to plow into the development of the Gunnison in situ copper project. Now, this is the mining life cycle map, and really, we are stuck in development. So in summary, Richard describes this as a science problem, and he's right.
But I think I listened to Rick Rule's comments on it a while ago, and he described Excelsior Mining. Someone said, "What about Excelsior Mining?" And he said, "Excelsior Mining is a science experiment."
Yeah.
That's all that he had to say on it. But I think the issues they're having prove him out, don't they? So they started off trying to just extract it with acid, then they realised that they were getting a build-up of carbon dioxide, and they had to flush it out with water. Now they haven't got the water, and they've got to create it. And it's like, yeah, you haven't actually fixed this process, and until you fix this process, it isn't the lowest cost producer. It's just a producer with an idea.
Yes, that is all true. But if they do finally manage to get this working, the economics look great. But their solution, which is they're going to have to pump acid down, then flush the well with water, pump out the water, put more acid down until they've got rid of the calcite. That delays production from each well. You need more wells, which means more capital to get to their production target. So time delays, capital delays. Actually, that's all expense. And right now, I remain hopeful that they will eventually get this right. I'm down 50% of my shares. but I'm sticking with it actually. And medium term, I remain hopeful, but I'm not buying any more.
Well, I hope you're successful, Keith, and maybe you can buy me a glass of wine on the proceeds in the end.
Yes.
Seriously, I hope you're successful. Obviously.
Well, this is a hopeful chart from their latest presentation. They reckon they've found a solution, but I think their solution requires a lot of capital to actually implement. And I really hope the shares have hit rock bottom. And I'm reminded of the X-Files. I want to believe. So then we were strongly positive. My view now is this is speculative. You really have to believe that they're going to get it right eventually. And I'm sticking with it, but I'm not buying anymore. Okay, on to Emmerson. Now, Emmerson, we covered in April, and we were negative about it. We were negative about it on the back of we believed that the potash market was oversupplied, and we therefore didn't believe that economics of Emmerson were going to be as strong as the company forecast. But since then, the shares have returned 27%. Now, and this is the share price of Emmerson, and this is fertilizer prices. And what has changed is that Europe has had an enormous energy crisis, which we have covered extensively in the weeklies. And if you haven't watched the weeklies, every week we do a market and macroeconomic update. And we've talked about it extensively there, and we'll be doing so throughout the year. And fertilizer, ammonium nitrate fertilizer, is essentially made from natural gas. And as natural gas prices have spiked, so European fertilizer manufacturers have gone offline and fertilizer prices have gone through the roof. Now, it is not just ammonium nitrate prices that have risen, but all fertilizer prices. So DAP is diammonium phosphate. Those are phosphate fertilizers. And potash, that is potassium chloride, I believe. That has also risen strongly in the second half of the year. Now, in part, that is because of sanctions on Belarus. And Belarus are the world's second largest producer, and you will be aware of the EU's disputes with Lukashenko, who has been trying to push Iraqi refugees across the Polish border. There are sanctions on Belarus, and all of that has had the effect of tightening the market. But this is from our original presentation, and then we believed the potash market was fundamentally oversupplied. There was a lot of new capacity coming online, and market commentary was that producer discipline would be necessary to maintain prices. So we were skeptical about Emmerson adding capacity to a fundamentally oversupplied market. But they have got preliminary funding to continue their feasibility studies and mine development plans. And we are now, well, I am more positive on the back of rising fertilizer prices, but I don't think that potash is necessarily the best commodity for speculation, as I don't think there's fundamentally a structural shortage in the way there is for, let's say, copper. So the good news is Emmerson have got preliminary funding for the project development of 47.5 million, with a further 20 million available, and the Kmezet potash project has now moved into the pre-construction phase, but it then will need to secure capex of 411 million to actually develop the asset. So, but above all, the price of fertilizer has shot up in part because of these sanctions on Belarus. And if those were to end, then you'd expect potash prices to come down, and that is making hostage to geopolitics. And also, there's just a lot of projects in the pipeline. For just one, Anglo American's Woodsmith polyhalite project in Yorkshire will add 10 million tons of polyhalite a year from 2024. So, in summary, we're originally negative. I have now moved I've become more positive, and I view it as speculative. Richard.
Yeah, I'm a bit negative, really, Keith. I think I know fertilizer prices have gone up a lot, and at some point the natural gas issue will get resolved. But in fact, as we move into the summer, natural gas prices will drop. The fertilizer prices will drop concomitantly. We don't know, what the extent of that's going to be. So there might be a bit of a blip up in the price of potash. I don't know, but I suspect it won't necessarily be particularly long-standing in the scheme of things. And given the sort of stage that Emmerson are at, it's not clear that they're going to benefit from it anyway.
Okay, and finally, number 10, Anglo Pacific Group, which we covered, one of the first companies we covered back in February. And our podcast has since had 861 views, and the shares are essentially flat, although we were strongly positive. Now, this is the share price, and it pays a decent dividend. Anglo Pacific has had a really big year. It has transformed itself with the biggest deal in its history, which was the acquisition of the Voisey Bay cobalt stream. And it has moved out of its remaining coal assets, which it only has a little bit of metallurgical coal left, and it's moved into battery metals. So you'll see December 2020, which is the breakdown on the left, it was 30% 21st century commodities, which are base metals, uranium, vanadium. And by the 30th of June, it was 75%, with half of its pro forma net present value in cobalt. And viewers of the weekly will know that the cobalt price has been astonishingly strong this year. And so that should have been very good for Anglo Pacific. And recently, it has sold its thermal coal assets as well. So in 2025, it's aiming to be 85% 21st century commodities with just a little bit of coking coal and other assets. And this is the cobalt price, which has risen very strongly since the deal was announced. I think it was back in March, but the economics had been negotiated prior to that. Unappreciated by the market is the fact that Anglo Pacific actually has coking coal, Kestrel, which is at the peak of its production now. The company that the mine that they own the revenue royalties over is now mining their core royalty areas. And over the next 2 years, the revenues from the Kestrel mine will peak for Anglo Pacific. And obviously coal has had a very good run, but the market does not appear to have been appreciating that. And this is the copper price, which has remained elevated throughout the year. If we look at the Q3 breakdown, which is the most recent numbers we've got, you'll see Kestrel has had a huge jump in profitability on the rise in the coal price, and we're starting to get revenues from Voisey Bay. And between the two of them, that is 18 million out of 24. So those two assets are 75% of the income stream. So this is my back of the envelope calculation for 2021 earnings. And I reckon we're probably on a P ratio about 9.9. So not great, really. You'll notice how high the tax rate is, 31.6%. Now, the Canadian tax rate is, I believe, lower than that. Depends on which jurisdiction you're mining in. But anyway, hopefully, because we're now getting earnings from Voisey Bay in Canada, the tax rate should come down marginally in coming years. Okay, so in summary, I think this is a solid and growing income play, and by 2025 the portfolio will be 85% green technology commodities. 2021 was really a transformational year for Anglo Pacific, led by Julian Tregar, who's actually going to leave now. So there's then a question of the direction of the company after he's left. But the stock market just does not seem to have appreciated the strong income growth in Q3 and Q4, and the shares yield 5.2%. And going forwards, as the Voisey Bay completely comes online and develops, you should see growing income from the cobalt. But we started covering the mining royalty companies because of the historic performance of companies like Franco-Nevada. And what became very clear as we covered Anglo Pacific, Trident Royalties, and Altus was that there was now a whole ecosystem financing mine development, and the process had become more efficient. And so the extraordinary returns you saw 20, 25 years ago were unlikely to be repeated. However, I think Anglo Pacific are growing a portfolio of assets which make it a good medium-term growth and income play. But when I say medium-term, I think years, not months. So we were then strongly positive. I am positive.
And likewise, I think your last point is really important, Keith. This is a sort of business that takes years to mature, and it's in that maturation process. And as long as it has good management, and clearly there's a bit of change in management going on now, it should continue to mature. But it is a long royalty companies these days. They I think they are a slow burn, but decent yield. If you hold them for a long time, you can get a great return for them.
Okay, and that is it. That is the first 10. And as I update the remaining 35, we will put out a short podcast updating on them in batches. In the meantime, thank you very much for watching. I hope you will press like and subscribe to the channel. And it is goodbye from Richard Wheater.
And thank you very much to Keith for doing all of that work, a lot of work, and I think it's a really useful piece of work to do. So thank you very much, Keith. And it's also goodbye from Keith.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.